Yeah, so thanks for being on Private Equity Confidential. So I guess my first question to you is, what in your view are the top faculties in the world for private equity? Obviously, Oxford, which is yours, but what would you name as the top 5 or 6 faculties as centers of excellence for private equity globally? In terms of depth and of teaching, research, however you measure it.
I think it's a bit more about individuals than an institution, because usually if you manage to already have 1 or 2 knowledgeable people in private equity is already a big deal in an institution. I think that in Oxford we have a few people indeed. We have Tim Jenkinson and Thomas Hellman. Tim being venture capital and leveraged buyout, Thomas Hellman being mainly venture capital. And then we have some other people around, but the core of the academic or the faculty are these people. The other strong place in private equity is clearly Harvard. They've been doing this for a very long time. There is this shocking statistics I once came across actually by doing that work 10 years ago. I was collecting data on who are the private equity partners in major LBO firms. And then I was looking at whether they had an MBA or not and from which school. And I found that about half of them had an MBA, and it was 80% of the ones with an MBA was a Harvard MBA. So it's an incredible concentration of one degree in one industry. Like venture capital would be more dispersed. You would have some people from Stanford, Chicago, MIT, etc. But in the LBO side, it was all like Harvard MBA. And perhaps because of that tradition, or just coincidentally, they have some very strong academics in private equity. They have George Lerner, Paul Gompers, and Victoria Ivashkina, who are the 3 leaders there, and there are a few more academics in this institution as well. Then you have some a bit everywhere. Obviously, Steve Kaplan is the first academic who has studied private equity and still the leading figure, I would say, in that field. And then you have people like Per Stromberg, who are in Stockholm. You have Antoinette Shore at MIT. You have people everywhere doing some good work in private equity.
Okay, that's interesting. Thanks. The other thing I'll be interested to get your views on is, in terms of the research that's done in private equity, a lot of the research depends very heavily on data from North America, but obviously the private equity world, consists obviously of Europe and all the emerging markets as well. Do you think that a lot of the research relies too heavily on North American data, and could more be done to, say, develop data or to do more primary research in other geographies, perhaps?
It's an old topic, because in fact it is like that. It's in fact even more dramatic in other fields in finance. So there are 2 things that explain a bit the state of affair. One is that America has all the best universities and has all the top journals, and so to publish papers you need to be relevant for the people who are the editors and referring, etc. And they're all based in the US. And so this has changed a bit for the better, but when I started my PhD, it was to the point where when I was at INSEAD, we would be asked to print our papers on American-sized papers, so to bring physical paper from the US to print on American-sized papers, but when we send our paper around, nobody would detect we are European, or nobody would immediately see we are European. Like the paper format even was American. So of course, like if you are at that degree of obsession, you are clearly, your topics need to be very interesting from an American audience perspective, and so it would always be very American-centric. Now, that said, there is another big element, which is that the US has always been also much better at funding universities, and that then in turn went into funding databases and the like. So one of the big research streams in finance, especially in the 80s and 90s, were on mutual funds. All the papers written on mutual funds are on American data. They have the most comprehensive data sets on mutual fund performance. Still to this date, I don't know if we have a survivorship bias-free mutual fund database in Europe, or let alone outside of Europe. the only survivorship bias mutual fund database I know of is in the US. And even stock market data, like just data on returns, accounting, statements of companies and the like, what we have in Europe is very rough. And it is very comprehensive in the US. So the data in other fields is even more tilted towards the US. In private equity, the data comes from the US, but it is funds that US investors invested into, and so they have also non-US funds. So if anything, there is less of a US bias in private equity research than in other parts of finance research. But yeah, it's a very strong tilt. It is changing. There are people now publishing papers on China, for example, and but it is a bit difficult to walk out of a dominant geography.
Okay, it's interesting. Obviously, I read with great avidity academic papers on the topic of private equity, and I have the luck of having an undergraduate degree in engineering, which means I'm fairly good on statistics. Do you think there's too many academic papers on private equity seem to be, or many of them seem to be based upon multiple regression? Is there too much multiple regression studies in private equity, and could there be other types of approaches to the data or to the analysis apart from multiple regression and t-tests? Because there's a whole lot of them, right?
Yeah. The other fields have also started with similar research tools and have developed other tools, but we have difficulties doing it in private equity because we do not have many natural experiments in private equity that we can experiment. So a big set, a tool that is becoming actually even dominant in other fields, in finance and economics in general, is things that are natural experiment that you either set up yourself or that just happened, right? So, for example, a company that does credit cards, they do a project joint with academics, and then randomize, who gets a certain credit card limit and who gets that kind of interest rates and so on, randomize it across their clients, see how they react, collect all this data, analyze it. So this kind of things is done in other fields in academics. We just don't have yet anything like that in private equity. Same for like random shocks or like regulatory shocks that really shock the entire industry. There's a lot of difficulties just getting data, so it's a bit difficult to step out of multiple regressions. There are people that are not in finance, that are not economists, who do study private equity. You do have people in law schools or in sociology department studying private equity. They usually don't like to use these tools. They use more like interviews and the like. Economists don't like too much the interviews because they think it can be a selected sample. It's hard to get hard objective information out of interviews. And so economists are quite reluctant to go towards surveys or interviews, but they are moving a bit in that direction. So 10 years ago, I launched a huge survey with someone called Marco Darin of investors in private equity, and we had the chance to have 200 institutional investors, pension funds, endowments, etc., around the globe answering our survey. And it was a pretty demanding survey about how many days do you spend on reviewing a fund, what kind of metrics do you use, etc. Very comprehensive survey about what is it like to invest in private equity funds, what is the due diligence you're doing, etc. And when we submitted this paper to a dominant journal in our field, we got a desk rejection, meaning that they didn't even bother to read it. They just said, we don't publish survey-based paper. Ironically, the same journal has now published 2 papers by Steve Kaplan that are survey-based of GPs. So the world is a bit changing. We did eventually publish our paper, but not in a very good journal. And nowadays, the papers by Steve Kaplan and Paul Gulpers and their co-authors that use survey data get published in good journals in finance. But you may need to be called Steve Kaplan or Paul Gulpers to pull that one out, because other people may be desk rejected still today if they submit a paper that is survey-based. Interview-based, we still don't do it in finance, in economics. We are still very nervous about just interviewing people, writing down some answers and saying, oh, it proves X. It's hard.
Yeah. Okay, well, I guess that brings me to my other question, which is obviously apart from the more rigorous academic approach, a paper that might be written by someone like yourself, you've obviously got a lot of studies about private equity field done by, say, management consulting firms like a Bain and Company, or Big Four like an Ernst and Young, or Cambridge Associates, and they seem to be quite varied and possibly of mixed quality. I mean, a few of them may be just promotional tools for a media organization. But what's your take on the general quality of the landscape of the kind of management consulting type studies? So not necessarily rigorous academic ones, but they tend to, often they can be, some can be quite useful and some maybe less. But what's your sort of take on the landscape of that kind of studies that are out there and done periodically?
It can be useful when somebody doesn't have an agenda and just describe some facts and data points, because in academia, we don't get rewarded for just, saying, here are the different fees that people charge, here's what the contract would look like. That would never make it to an academic study. And I wrote kind of papers a bit of that style, but I refrained myself, and because they are not rewarded, it's not seen as academic work, and yet they are useful. And so when you have practitioners writing a report saying, okay, this year there is an increase in the number of funds that do not have a hurdle rate, there is a decrease in the number of funds that have, a 2% management fee during the investment period, this kind of report is very useful. It's descriptive, they have collected the data, and they say, here's the evolution. There's no agenda behind it. These are very useful reports. Where it's less useful reports is maybe in the majority, unfortunately, are people who have an agenda. And so they come out and they cannot be upsetting their clients. So even if they don't have an active agenda, there's an implicit one that they cannot upset their clients. Their clients usually are the ones with the most money, and the ones with the most money are private equity funds. So, and then we see all kinds of studies that are, it's either by incompetence or by malevolence that people are doing things that are not right. Like the biggest example I would give, without like going to the classic IR that I can get pretty mad at, but one very classic one is people just say, oh, we calculated the growth in earnings in private equity owned companies, and it is much higher than publicly listed companies. And typically there is no adjustment for add-on acquisitions that are externally financed. And it's just like completely obvious why the growth is higher. Like there is tons of add-on acquisitions in private equity compared to public equity. And so of course the earnings growth are going to be higher. It doesn't mean anything. And yet people publish reports after reports with these kind of statistics and concluding whatever they like to conclude. And there are even people showing like the accurate data, but then in any case concluding differently because it's in their best interest, and because people usually don't go beyond page 1 and don't check all the data points and say, oh, hold on, your data is actually not proving what you're saying is the opposite. So a lot of these reports are a bit difficult. The Bain one I actually quite like overall, like the annual report, I give it to my students every year. It comes out in February or something like that. So like in a couple of months, there will be the new one. I quite like it because it doesn't try to sell anything. It does tend to be kind to the industry. They're not going to be saying things that are like that negative, but they tend to lean on the descriptive side. Like, this is the ratios that are usually calculated. This is what they look like. This is the evolution. Then it's fine.
Yeah, I think you're right. I mean, obviously, there's a tendency for the service industry to be ass-kissing the investors, which is sort of inbuilt. And I certainly take your point that there is a mixed quality. I mean, I would say at the moment, a lot of this ESG stuff tends to be kind of pretty ropey. It seems to be the new thing now, if you look at sort of social media compared to, say, cryptocurrency 2-3 years ago. So I certainly take your point about... But
it's not private equity only. If you go on ESG, there was a report from the European Union that came out, or the European Commission that just came out, where they said, oh, studies show that returns are higher when companies have good ESG scores, and therefore it shows that they should do ESG. So first of all, having higher returns means you have lower prices, so it's not clear that this is really the objective. Second of all, they cited 10 studies that shows that. There are at least as many studies that shows the opposite, and neither set of studies is making any sense anyway. But like you can even have something like the European Commission, and it was joint, I think, with ENY, and if it's not ENY, I apologize, but I think it was ENY that was doing it with the European Commission. And you have a report like this, it's just purely ridiculous. It's purely what, you know, the client paid you to hear something, you write it, and often, you know, you can have a big name and it's impressive to hear that it's McKinsey who signed the report or ENY or somebody like that. But at the end of the day, the people who did this are 20 years old that just come out of school that barely understand the vocabulary they are presented and the data that they are presented, and just come up with some fancy graphs. That's the real.
No, that's absolutely right. I mean, I remember seeing these ESG so-called ratings, and you'd have 5 different so-called ESG rating agencies coming out with completely different ratings for the same company. I mean, it wasn't like Standard & Poor's, Moody, AAA or AA. It was like all over the place. So I think there's a lot of work to be done there. But I certainly find it quite irritating, the whole ESG thing, as it pertains to private equity, because it's a lot of it's ideological and there's just no science behind it. So I think you're right when you say that. Okay. My last topic. Thanks for your time. My last topic is I was wondering what's the best way for an academic to engage with the private equity community, you know, say with a GP like me, or with an LP, or with anybody else in the ecosystem. Obviously, should the academic be very independent, or should they try and not ruffle feathers too much, or is it an individual choice of each academic? Because it varies from, obviously, your paper of this year ruffled feathers. Other academics might get Henry Kravis to write the foreword in their book. So how does the spectrum play out if you're an academic? I suppose it might depend. So what do you think about that?
You choose. It's everybody's choice, and there is no school saying you should not do this or you should do that. My school might have lost some donations because of what I said. There are some. I took this example recently where like Imperial College got like a donation from an alumni who was in the hedge fund industry giving 10 million. If there would have been a lot of research coming out of Imperial that was negative about hedge funds, these alumni feelings towards giving money to Imperial might have been affected. So usually if you're tough towards in people of power or people with money, it does hurt your school, but it is a pretty strong line that people wouldn't dare to cross, and so you never get any instructions as to what you should say and shouldn't, as long as you haven't lied, as long as your work is honest, and it is totally fine. So then it's down to everybody's choice. My view of in general is that you want to be sufficiently close to practice, which is a bit unusual for academics, but you want to be sufficiently close to practice to really understand how it works, but you don't need to know, you don't need to do a deal yourself or something like that, unless you have a research question that really pertains to the problematic of making a deal. So you need to be close enough and have a dialogue open in order to understand things, because you also need to teach them. You need to bring in guest speakers, etc., that will give practical aspects to students and so on and so forth. So you need to know practice well, to do your research well, and to do your teaching well. There is no reason to get in bed with your topic of study, right? And so, but of course, the problem is that I don't think it's strategic. I think that genuinely, when people are spending so much time, we're talking about spending 40, 50 hours a week over the last 15 years doing private equity related work, right? So you don't spend that amount of time if there is not something that really intrigues you with the topic. In my case, it's just a mix of curiosity, intrigue, and then I've built so much in it. There is a fixed cost fallacy that has come to it as well. But for a lot of researchers, they choose to work on private equity matters because they're fascinated by it. They find it very exciting, almost by definition, right? You don't study chemical engineering if you think that this is all crap and useless, or just lead to a destruction of Earth. So an engineer, a nuclear engineer, believes in nuclear energy. Pretty rarely they think that this is like the worst way to provide energy, to generate energy. So it's a bit the same here. Necessarily, you're going to have a bit of a self-selection whereby people who are fascinated and find this industry really cool and nice will tend to pick this topic. Nowadays, as the field is democratizing, there are more people working in private equity. We see people with diverse feelings and backgrounds coming into private equity. And we now see some papers where people are looking at social consequences of private equity with a different feeling than, you know, the hardcore economists used to. And so you do have more diversity now, and that's good. I contrast it often with other fields in finance where, like, mutual funds research was very much anti-mutual fund. It's all the research that said active mutual funds just underperform monkeys, you know, like you better choose stocks randomly than like trying this. And so the tradition in academia was very much like practitioners are doing things that are not that useful for society, and they were pretty critical. And private equity has been quite an exception. And in a sense, my mindset is very much in the tradition of academia in that field, but in private equity, I'm very weird compared to my colleagues. But again, I think there are more and more people that are coming into that field as it democratizes. And so there are more people that come in with my mindset, very skeptical, and just are curious and want to understand better.
Yeah. Okay. I guess let me ask you my last question, which is probably very dear to my heart, because as you probably have gathered, I'm a mid-cap fund manager. I've always managed funds of, you know, 100 million, 200 million, thereabouts. And if we divide the private equity world into larger buyouts, and growth and venture, do you think that the buyouts and, say, venture get more of the attention and the growth? That's certainly my experience, although the growth kind of deals maybe are more the bread and butter of the business. But what do you think about the sort of focus? We
do have some papers, like there is a very big study on French data which is mainly growth equity, where that looks at all the deals financed in France and how these growth investments function. There are less of these deals a bit in the US, and because the US dominates so much the databases and the interest, you have a bit less interest in them. But the rest of the world is mainly growth equity, right? Like all the developing markets, etc. So you have one reason we don't do too much of it is because we are so US centric. But there has been some papers. There might be more papers. There will be more papers coming on that segment. But it's true that what grabs the headlines will also grab the attention of researchers, and it's going to be the big things, you know, what in dollar terms, you know, makes a big impact. And then the things that are these fast growing companies that goes from being nothing to just have like a monopoly on the world search engines or something like that. So you will necessarily have people attracted to these attention grabbing type of topics. And you have a lack of data as well. It's harder to get data on things that are a bit smaller, right? Getting data on growth equity, like, it's pretty difficult.
Okay, well, I think that covers everything I wanted to talk about. I certainly hear about your independence, because I have got into trouble with my LPs a couple of times because of my channel, but they did get over it. But because as you know from my channel, I don't mind. You know, I'm not one to sugarcoat, and I kind of call it the way it is. I try to, although I'm a GP, so I've got LPs to worry about, but hopefully they get over it. Okay, so that's it really. I don't know if there's anything you'd like to ask me about my channel.
It was nice talking to you. Thank you very much. You were asking about the sorts of things that people do and write books and the like. I just released a dictionary actually of private equity right on time for Christmas. So this can be useful to some people.
Do you have a copy you can wave up for me, or
I don't have a paper copy. I just posted it on Amazon like yesterday. Okay. It's available on Kindle and on hard copy, and it's very cheap and should be a bit fun. But so that's the latest thing that I've done.
Okay. Well, thank you very much, Ludovic. I guess I wish you happy Christmas, and we'll be in touch in the future. Thank you very much.
Thank you. You too. Bye-bye.
Okay. Bye-bye.